Now, all of that being said, we did have one question that came in via email from Tony, and this is going to be very quick, only about 6 or 7 slides for this potential answer, I believe. Well, and my thoughts, in my opinion. Is there a preferred strategy for a stock split coming up? Okay. Tony's direct question was, when a company announces a stock split, the stock many times increases in value as it runs up to the split date. What is the best option strategy to take advantage of that situation? Well, the answer to the question is sort of in the question itself, in my opinion. What I mean by that is you're expecting the stock to move up. You're just going to be focusing on a neutral to bullish options investing strategy. Capital intensive, shorter term, you might look at a covered call using weekly, 2 week out, or shorter term covered call positions to knock down the cost basis if you wanted to buy the stock, of course, in the pre-split price. You could also look at a standard collar or potentially a cash secured put. If this wanted to be longer term, that you wanted to continue to trade the position leading up to the split, you could look at a married put, maybe a calendar collar where you're buying a put far out in time and selling near-term calls against it, or you might do a far out in time, maybe 5 or 6 month out covered call position or cash secured naked put. If we're looking to generate income in the shorter term multiple times, maybe leading up to the split date, you might use some leverage strategies, a bull put credit spread, bull call debit spreads, a shorter term diagonal calendar spread, or poor man's covered call position. If you know that the date is a few months out in time and you want to look for a position that might grow, but using leverage, you might just buy a call that's further out in time, do a far out in time bull call debit spread, or do another diagonal or poor man's covered call, but using a leap option and then selling shorter term against it to knock down the cost basis of that long call, which would have a cheaper price than buying the stock position. The key would be to assess your goals. What are you looking to achieve up to or after the split occurs? Are you looking to simply profit in the short term? That would lead to shorter term, maybe credit spreads or debit spreads with leverage, maybe a cash secured put if the stock's at a reasonable price now, likely isn't if it's the one we're talking about. Are you looking to generate profit to eventually buy into the stock post split at a better price? Still, you might use cash secured puts, you might use leverage positions such as bull puts or bull call debits, or of course, you might use that diagonal calendar spread or poor man's covered call position. Or are you trying to position yourself to get into the stock at a discount to be a long-term core holding in your account? Well, same thing again. You're going to look to do shorter term income, maybe with the leverage position, so you don't have to buy the stock at the higher price, profit or pocket some of those potential profits going forward. So when the split happens, now you can buy in and you've got a cushion already for the cost basis by the additional premiums you've generated. Of course, this question is likely due to the announcement by Alphabet, or Google if we want to call it. On February 1st, they announced a 20-to-1 split. Google closed today at around 2866. So when the split happens, it's going to go down to about 143.30. The stock's going to be at a different price when this happens, but this is what we're looking at right now. What's the benefit of this? Well, at a price of 143.30, it's more attractive and attainable for retail investors to buy as a stock naturally. By the restrictions of inclusion in the Dow, this might allow Alphabet to now be one of the Dow stocks at the lower price threshold. The change is to occur on July 15th, 2022, of course. The new price, the 20-to-1 split, that's the 18th. I'm sorry, July 18th, not the 28th. That's a typo. My apologies. So the new price post-split will start on the open on July 18th. That's Monday, of course. Now, some of these discussions, we don't know what the stock's going to do. It's going to also be based on what the market does in the next few months leading up to it. And the rising tide lifts all boats. The sinking ship also lowers all other boats as well. This is similar to Apple back in 2020. Now remember, Apple, of course, did that 4-to-1 split on August 28th, 2020. The new price started trading on August 31st. Went from about 500, I think, to 140. Leading up to that, the stock was up in price. This is a chart from July 10th of 2020 up to September 10th of 2020. We highlighted the split date there as well. But keep in mind, the market as a whole was actually going up during that time period mostly as well. Coming off the March lows, March 20th, March 26th of 2020, leading into April, May, June, July, a little bit of pullback, remember, going into August, and then started to see that rise up. This is a similar chart to what we saw for SPY and for QQQ during this time frame as well. So remember, the market conditions are also going to dictate what the stock is doing. It's not a guarantee, and Tony mentioned that. He says most of the time. It also depends on the current market conditions as well, how the stock is going to perform heading up to the split date. But again, in the simplest terms, if your outlook and expectation is bullish leading up to this event, you're going to focus on neutral to bullish strategies. If we're talking about Google, personally, I'm not going to do this, any of the capital intensive positions, just because the current price of $2,866 per share. I'm not going to do a covered call, well, a full secured covered call. I don't do covered calls on margin personally either, but I'm not going to do a full cash secured put. I'm not going to buy the stock and do a collar. Likely not going to do a married put. I might after the split, but we'll have to see where the price is then, depending on where Alphabet goes to during that time. Of course, we might look for a far out covered call or cash secured put. But again, we're probably talking more about the leverage positions in the shorter term. You feel the stock's going to move up going up to the date, bull put credit spreads. Still staying out of the money, looking for that reasonable probability, 80, 85%, good range out of the money, still looking for double-digit returns. Bull call debit spread, you might go to a 30-day out, slightly less in the money, maybe closer to at the money with a 2-to-1 or 1-to-1 risk-reward ratio, or a shorter-term diagonal calendar spread. Of course, looking longer term, you might buy a call that's 4 or 5 months out in time. You might do a 3-month or 4-month out bull call debit spread, or buy a leap option, which would be pretty expensive. I understand that, and doing the poor man's covered call. But ask yourself, are you looking for short-term profit leading up to it? Are you looking to generate income with other strategies to pocket some of the profit because you plan to buy it post-split out to July? Or do you want to own the stock long-term but knock down the cost basis pre-split? So just keep pocketing premium as you're doing there, but you still want to have it as a core holding in your account. And that's what you want to ask yourself going forward. But if your expectation is relatively neutral to bullish, of course, then that's what we're going to look at